Absolute return. Total return of a portfolio designed to perform without reference to any market measure. Although the objective is to make money regardless of market conditions, the word absolute in this context means independent, not positive. The relevant distinction is with relative return, which aims to outperform a market benchmark or mutual fund grouping. The classic example of an absolute return is that of a hedge fund held by wealthy investors and using strategies such as selling short, arbitrage, and leverage. Since 2008, however, the uncertainty of financial markets has spurred the rise of ordinary mutual funds combining asset classes that characteristically respond in opposite ways to different economic scenarios. Known by such names as absolute return funds, absolute value funds, market neutral funds, and permanent portfolios. They hold assets that correlation analysis show move either in the same direction, positive correlation, or in a negative direction, opposite direction, depending on market conditions. For example, in a market influenced by rising inflation, cash-related investments would fall in value, reflecting the dollar's declining purchasing power, while gold, being a time-honored store of value, would probably rise. Cast by a correlation coefficient, which would be somewhere between -1, representing perfect negative correlation, and 0.1, representing a perfect random relationship. At the other end of the range is +1, meaning perfect positive correlation. Correlation is a statistical computation, and the resulting coefficient is a measure of degree. Perfect correlation is very rare. The concept of a permanent portfolio for average investors was championed by the late Harry Brown in his 1998 book, Fail-Safe Investing, which postulated that all possible economic outcomes could be reduced to 4 categories. Prosperity, inflation, deflation, recession. An unmanaged portfolio of equal dollar investments that respond to each of those conditions, some correlating positively, others negatively, would, if annually rebalanced and held long-term, be both profitable and protected from serious losses. His choice of assets was stocks, long-term bonds, gold, and cash, T-bills. Historical evidence was strong that over broad periods of time, the winning investments would add more than the losing investments would subtract, and Brown's fund averaged 6.38% over a 25-year period, with only 3 losing years. Mutual funds, using variations of Brown's concept, usually with enhancements adding some degree of risk, have not been around long enough to provide meaningful long-term history. In a few tumultuous years, they have been popular. They have had both gains and losses, but generally have tended to experience less variability than related returns. That was a mouthful.